Recently saw a video warning people to be cautious about investing in Mansa X. And in the video, they cited rapid assets under management growth as the main issue people should be careful about before they invest in Mansa X. So that is what inspired this video, and I thought it is a conversation worth having because I think he raised a very important point. And of course, I like discussing the what if so that we are prepared for anything. Okay, these are things that you're going to be seeing in social media. They are things that you're going to be seeing here on YouTube, and because you're an investor, we don't want you to be having mini heart attacks, right? Or if you're planning to invest, we don't want you to be scared away before learning everything about these. I want you to be confident in making an investment decision and make them from a point of information, okay? So every day here is a learning day, and here at Study Well, we make it our business to study and understand investments. If that is something that interests you, make sure that you hit that subscribe button and let us dive deeper into what rapid assets under management growth means to the fund managers as well as to you as an investor. So first off, I would like us to set some facts straight, okay? So at the end of Q3 of 2025, Mansa X was managing funds for over 50,000 people with around 99 point something billion assets under management. That is in Kenya shillings, and this is for Mansa X Kenya shillings account and Mansa X USD account. And from this, you can see that people are really investing in Mansa X. And this is maybe because of the low returns in treasury bills, treasury bonds, and also money market funds. And from this, there has been a rapid asset under management growth. And because the figure now is surpassing 99 billion recently, up from 34.2 billion Kenya shillings in last year, that is late 2024. And this scale up is common for high performing special funds, especially when they're giving very good returns, but it also brings some trade-offs. And today in this video, I would like us to outline the key benefits and also key risk that you need to consider before investing. And we are drawing from the general principle of a multi-asset fund where they do long and short trading models like Mansa X, which invest in equities, they invest in fixed income funds, they invest in derivatives, and other more. In fact, they invest in almost 200 assets. Now, let us look at the key benefits. And the first key benefit is economic of scale. And I know this, you know very well, the fact that when you have a lot of money, you are able to even negotiate for some things that if you don't have that kind of money, it's hard to negotiate, right? So they can negotiate better trading fees, they can negotiate better custody cost, they can negotiate or potentially sustain its average 17% annualized return because they have the power to negotiate for better deals, okay? And the second benefit is also associated to the first benefit where we are talking about negotiation. We have talked about negotiation of fees, and now they can actually be able to secure preferential access to deals. They can also lower borrowing rates or exclusive opportunities in some assets, opportunities that are not readily available for people with low cash or they don't have high assets under management. A very good example of this and something that is close to us, most of us may know this, is when it comes to bidding for bonds. We know that there are competitive bonds and we have non-competitive bonds. And we know that competitive bonds are for people who have a lot of money. So institutions and people who are high net worth people, they want to invest high amount of money into bonds. They are actually given an opportunity to set their own rate, right? So this is an example of the fact that high assets under management can be able to help you negotiate or can expose you to preferential access to deals, all right? Number 3 is stability and talent attraction. When it comes to high assets under management, it means that the company is also earning more, or there is more income for the company, which allows them to attract top analysts and build stronger teams. In short, when the asset under management is high, they are able to acquire a talent that is top notch, and they're able to get people who are good at their job in terms of, in this case, analyzing the market and making informed decisions that will make you more money as an investor. The other thing is high assets under management comes with better diversification and liquidity. So when it comes to larger pools or high assets under management, it enables broader asset spread in terms of they can identify better opportunities and invest in diversified assets, right? And it also comes with the ability of handling redemptions, because now we are talking about more money in the company, and the redemptions, they can be able to handle redemptions easily, or liquidity, because now it will mean that they can have a large amount of money invested in different assets, and at the same time they have enough money in cash and cash equivalents to cater for those people who want to withdraw, right? Now I would like us to look at the risk of rapid assets under management growth, and here a few things can happen. So the first thing that can happen when you're managing a large amount of money, it becomes very hard for you to deploy capital without affecting the market. And I will give this with an example. Suppose a fund manager is confident that, let's say, KCB shares will perform very well maybe in the next 3 months, and this would be to the benefit of the investors. So for them, they have analyzed the market and they have seen that this is a great opportunity for the investors. Yeah. So they decide to allocate 10% of their assets under management to KCB. Now, for such a fund that has a high assets under management, that is 80 billion, let's work with 80 billion under management. And then we are talking about 10% of 80 billion, meaning that it is 8 billion Kenya shillings that they are supposed to put in KCB. But here is the challenge. Can the KCB market absorb 8 billion Kenya shillings in buying pressure without the price spiking? Probably not, right? That kind of volume would likely move the market, making it more expensive to buy and reduce the potential upside for this company in particular, or for this investor in particular. So the alternative would be to scale down the allocation or spread it across other assets. And in doing so, they potentially miss out on the full potential that they would have achieved if they invested a larger percentage of the asset under management in this specific stock. Okay. Meanwhile, let us take an example of a smaller fund, and let's see what would happen to that particular fund. Let's say a fund with 1 billion Kenya shillings asset under management, and in this case we are doing 10%. So 10% of 1 billion will be 10 million Kenya shillings, and they would be investing in KCB. And this, I think, they would invest comfortably without moving the market of this particular share. And even if the market would move, it would not be as high, or the rate would not be as high as investing the 10 billion, or yes, the 10 billion or the 8 billion Kenya shillings in the same stock. And I mean, would there even be liquidity for such an investment when you're talking about billions? So for a smaller fund, they can be able to enter and exit in such a market more easily. And if the trade works, they deliver outsized returns. And that is why larger funds tend to offer more stable returns or predictable returns, while smaller or newer funds might post even up to 30% returns or 25 plus returns, because they are more nimble and they can take concentrated bets, right? As opposed to larger funds or funds that have been there for a while. So what this means is, for a conservative investor, big asset under management means stability and also lower volatility. But for an investor who is looking for an excitement or alpha returns, smaller funds might offer more upside on that, although the risk is a little bit higher. But if you're looking for excitement and also for alpha returns, you might need to consider newer and smaller funds for this particular reason. Okay. The other risk that comes with rapid assets under management growth is the fact that such a growth requires a robust system or it requires scaling of the system that they have. And it also, that faster growth invites CMA scrutiny. And our hope in this case is that as the asset under management increases, the Mansa X team or SIB is going to improve their system so that they can be able to handle a higher asset under management. I recently saw a discussion about Mansa X and their custodian, and the discussion was about the fact that Mansa X has a higher asset under management than their custodian bank, that is I&M Bank. And this was a concern of a few people, but in as much as this is the case, usually the managed funds, they are not registered in the balance sheet of the bank. But what I'm thinking is this requires the CMA and the fund manager to make sure that their custodian is up to task, because the fund managers are the one who selects their custodians. So it goes back to the CMA and fund manager to make sure that their custodian is actually able to manage this kind of assets, or they are up to the task, okay? And the last risk that I'm going to be discussing here is the increased redemption pressure. And I want to talk about the instances if the fund reported lower returns than usual. It would mean people would start cashing out their investment because now the returns are going down. And when the returns are going down, most people would prefer to move their funds to somewhere else, right? So in such situations, we might see a force fire sale on some asset because now they have so many people that they are managing money for. If people start withdrawing, and I think this is something that would happen to every institution when we have a bank run, or when we have so many people withdrawing money from a fund that is ideally not supposed to be a liquid investment, because they're investing in instruments that are volatile. If we all go to withdraw our money from such a fund, because this is not a fully liquid fund, it would mean that they would be forced to sell the assets at a loss, and that way might make some losses from the particular fund. But again, this is a scenario that is unlikely, but it's something that can happen. And I think there is a company that suffered this not long ago, a company that we all know of. They experienced this because where they were investing the investors' money, it was not a liquid investment. And when people started withdrawing their money, or a lot of people started withdrawing their money, especially during Corona period, the fund now was not able to give back the investors' money. And from there, everything went haywire. Everything went down the drain, and it became a lawsuit. Yeah, of course, there were other issues that were around the particular fund, but again, these are things that we need to consider. And what this brings me to my next question. What does this mean to you as an investor, or what can you do? And I would like to start with, what can the fund managers do? So I think it highly depends on the Mansa X team and their management here. And there are different ways or things that they can actually do to mitigate the risk we have discussed of. So if people keep on flocking in due to the low rates in bills, bonds, and also money market funds, the fund can do a few things. Number one, they can do like a soft close, like pausing new subscription to just make sure that they are keeping their things in order. The other thing they can do is cap the minimum amount invested, and that will limit the number of people that are coming in. Or they can even create a feeder fund just to make sure that they are balancing, or they are managing the funds appropriately. There is a lot that can be done for the fund managers to mitigate the risk. And because of this, I think we don't have to worry as investors, so long as we keep an eye on the fund managers and their activities to just make sure that they are doing the right thing. Now, what can we do as investors? I think our job here is to monitor the fund fact sheet quarterly for signs of strains, and go through their financial reports to see how they are doing as a company, and just keep updated on the fund's activities. Now, I think the bottom line of this video is, yes, there are risks associated with rapid asset under management growth, but there is a lot the organization can do to protect you as an investor, protect your money, and make sure that you're getting your returns or your good returns. And here is where you come in as an investor. Since this is a liquid fund, if you see signs of strain, make sure that you make an informed decision. Also, the other thing that I like to encourage you guys, remember not to put all your eggs in the same basket, okay? Now, in my next video, I'll be discussing why some people got less returns than what they expected from Mansa X, or even they got a negative return. In short, you got less than what you expected, and I will explain what happened and how to avoid such scenarios, especially for those people who are new to or new investors, or you want to top up your investment. Let me know in the comment section, did you get the returns that you expected from Mansa X or what they reported, especially those people who joined the fund in the last quarter or Q3? Did you get negative returns or less returns than you expected? Or for those people who topped up, I would really like to know, or if you know someone who reported or who was complaining about getting returns that they never expected. I would like to hear that from you guys. Let me know in the comment section. So don't forget to subscribe so that you don't miss out on the video that I'll be explaining about that. And in that video, I'll also break down the Q3 returns and the fund features. If you learned something from this video, please give it a thumbs up. I would really appreciate that. And for those who are new to Mansa X, here is a video where we talked about how Mansa X operates, the risk and things you need to know before investing. Thank you so much for watching. Happy investing. See you in our next video. Bye.